Ready to go?
Ready to go.
All right, we got this. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey, everyone. Welcome back to another episode of the Amateur Investors Podcast. Ben and I are welcoming you back. I know we're on episode 21 now, Ben. How crazy is that?
It really is.
We're almost, 26 is half a year. We're going for 52 and trying to go past that as well. But
yeah,
really
we're probably
excited.
Going to pass that pretty. I think we're going to pass the 52 goal, honestly. I think the next one's going to be 100.
Yep. So on this episode, we're going to be talking about what are funds, what they are, and how to pick them. We're mainly going to be talking about mutual funds and ETFs. There are other types of funds, but those are just going to be the two that Ben and I focus in this episode. Just kind of a breakdown of what they are, and how they work, and how they function, basically. So starting us right off, an ETF stands for Exchange Traded Fund. Basically, this is something that trades exactly like a stock. It's basically like a security. It's basically normally tracks an index, a sector, a commodity, or other assets. So that can be, any multitude of things. It's sold on the exchange, same as a regular stock. And I know that's kind of like Investopedia's definition of it. ETFs are priced continuously by the market. So the value of the ETF may not be tied one-to-one to the net asset of net asset value of all the underlying assets. Ben, you want to talk about what a mutual fund is?
Yeah, let's do it. I think really what the goal is for this episode, like the I guess fundamental value of what this episode is really to drive towards. It's like if you take a look at your 401k or any of the traditional sort of like retirement accounts, unless it's an IRA or a self-directed 401k, you're going to be exposed to funds. And when you're dumping 5, 20, 30% of your net salary every paycheck, you're going to want to know what those funds are fundamentally, because if you're picking stocks, in Robinhood or whatever brokerage, Charles Schwab, you're doing your research, you're understanding how those companies tick. But when you're dumping just a ton of money into your retirement account, those investment theses really need to stick to your fund. So that's what this episode really is. It's to get a diagnostic on the health of your fund. So Chris introduced the ETF, the Exchange Traded Fund. An alternative to the ETF, and like Chris said, there's a lot of different types of funds. There's REITs, which are like real estate investment trusts. There's hedge funds that you've heard of. Mutual funds are a little bit different from ETFs in the sense that they tend to be actively managed. And you might have heard of index funds. That is sort of like the square versus rectangle sort of thing, that an ETF can be an index fund and a mutual fund can be an index fund. But the means with which they're executed is different. So whereas ETFs are priced continuously by the market, you look at your whatever brokerage app or on the website, you see the price moving all throughout the day. Sorry, I smacked my mic. The stock price is moving all throughout the day. The difference between mutual funds, when you execute an order, whether it's a buy or a sell, every single person gets exactly the same price, because like Chris mentioned with the ETF not necessarily tying to the one-to-one on the net asset value. That's the NAV. If you ever see NAV in your brokerage or financial resource website, that's what that's talking about. It's like, what is the value of the underlying assets? The mutual fund is priced at the end of the day. So no matter when you sell or buy that mutual fund, everyone who executed an order that day is getting the exact same price. So whereas there's a benefit to trading ETFs to get some arbitrage, like if you find that your ETF is undervalued based on a PE ratio, whatever, you can sort of get that arbitrage value. But with a mutual fund, it's sort of to me, it feels very antiquated, and it's much more illiquid than an ETF, where you can get in and out, depending on the volume of trade, obviously. But mutual funds tend to be a little bit more pricey. And we really just advocate for ETFs because if you're trying to do sort of a dollar cost average strategy, you really get the benefits with ETFs because you're pricing into a liquid market. So I'm a big ETF guy personally.
If I can add one little thing here, Ben, and correct me
Yeah.
if I'm wrong. I think when mutual funds normally they start to transact or whenever the sale or the buy order happens, I know you said it's like at market close. I think a lot of times if you look at Yahoo Finance or even if you look at Robinhood or whatever, you'll see like after hours trading. A lot of times that's when the transactions are occurring. So when you see like your stock or whatever go up or down relative to that, that's normally relative to the mutual funds or even hedge fund managers or whoever enacting the trades that they're forced to after market close. So, it kind of looks like I wouldn't say market manipulation, but you could see your stock move up or down in the after markets depending on how the funds are selling off or buying or whatever's occurring after hours, basically.
Yeah, mutual funds are kind of funky. I don't fully understand the mechanics of them in sort of like the back office mechanics of just like what does it look like to run a mutual fund. But what I do find interesting that I don't like about investing in mutual funds is investing in the ETFs feels much more of like an open sort of free market transaction where it's investor to investor transacting. There's a buyer and there's a seller, sort of like communicating that trade through the exchange. I don't want to say it's decentralized because it's not, but it's really sort of just like a structured bartership or trade there. But with the mutual fund, when you are buying, you are exchanging and transacting with the fund itself. So you are not going to, the NASDAQ to get shares of, mutual fund X. You are sort of going to the fund and they are providing the service. So you're buying from a company, which is very, very different from even buying just single company shares where they're just listed on the exchange. So I just tend to prefer ETFs because I feel like they're lower fees. The load cost is lower, much more liquid. And I just think you can extract more value out of the ETFs than like sort of a slowly traded, like friction filled, expense filled fund of a mutual fund. That's just like my bias there.
Yeah. So I know here at the Amateur Investors, Ben and I always talk, well, we've mentioned a few times in some of our previous episodes, expense ratios. So, normally we're always hunting for the lowest expense ratio. That's not always the case. Sometimes, if it's a very good fund or we think it has very good underlying assets. But basically, the way that I kind of look at it, and Ben, you can chime in on this. Normally, if I'm looking at something that has a very high expense ratio, but I like a lot of the underlying assets, when you look at the holdings of whatever the ETF or fund is, you almost get to a breaking point where it might be better to just buy the underlying stocks and almost build your own index. You're taking out the middleman and all the expense ratio that's wrapped up into it. If, let's just say I love they're buying Apple, Google, Tesla, all these different things, but the expense ratio is 1%. Why would I pay them to do that when I could just go out and buy Apple, Google, Tesla, Facebook? I can buy those companies on my own, and the only trade that I have to do is with the brokerage or whatever that small to no fee is. Basically, you're better off just kind of doing it yourself. Yeah, there's a little bit more legwork on your end. Yeah, you have to look at it if a trade starts going away, or you need liquidity, or a company, all of a sudden Facebook is not a good anymore, not considered a good company, and their stock price is falling. Yeah, you have to do more legroom on your end, but you don't get hit with all of the fees that would be associated with buying those underlying assets. Ben, you want to chime in there?
Yeah, I think there's definitely a cost benefit analysis and a few variables to consider. Like if you're looking at a fund strategy, you're definitely prioritizing the convenience and like sort of like laissez-faire approach to the investment strategy. So if let's just hold that assumption constant that like you are going to invest in a fund or passive strategy. One, I do believe that if you find a fund that is really a pretty expensive load, like where you have a high expense ratio, but they're invested, like look at the number of holdings. Let's say they're invested in 1,000 companies, but the expense ratio is 1%. Why not just buy an S&P 500 ETF and pay, 3 basis points or $3 for every 10,000 in a Vanguard or Charles Schwab fund? I agree with that. If you're looking at a high expense ratio fund with low holdings, as in it's a very concentrated investment thesis, unless they're like consistently outperforming their benchmark, I agree. Definitely. Like probably go invest, or you go to M1 Finance or something and create your own index of those specific companies that you believe in. If you're willing to do your own research, or just find some sort of comparative analog that has a similar thesis with a lower cost structure. Because if it's a really concentrated fund, and they're not outperforming the market, there's just no reason to be in it. You should just look elsewhere to try and match those returns, because otherwise you're just going to waste away your net profits.
And there's a perfect example of this. I mean, this is kind of, I guess, not an abstract way, but if you look about it, Gbtc is the Grayscale Bitcoin Investment Trust. They currently charge a 2% expense ratio. The reason that they can do that basically is because there's not really a Bitcoin or a crypto ETF yet. So basically, that you're giving them, that's a very high expense ratio, 2%. But Bitcoin's very volatile, and a lot of people can't own it because of restrictions of brokerages or the different issues that people are having, or they don't want to buy the underlying asset. So I know Ben and I personally, we like buying Bitcoin ourselves and self-custodying the underlying asset. Not saying you have to do that. That's what we recommend. But, let's just say you're in a retirement account and you want to keep it in a retirement account. The only way to really do that right now is through the Gbtc fund or that stock ticker. I know there's a lot of things in the pipeline. I know JP Morgan filed for one, Goldman Sachs filed for an ETF, Fidelity filed for an ETF. So I'm hoping in the long run that Gbtc, in order to be competitive, it's basically a free market economy. If other actors come in and they start offering 0.5% or 0.75%, that's going to help force Grayscale's hand to lower their expense ratio. And then you can kind of shop around for the one that's the cheapest. Grayscale still might have the advantage of being able to show like that, oh, we're only Bitcoin, or, oh, we're better at self-custodying, or we're not a crypto thing, we're only Bitcoin. So there's other things that you may be able to look at, but that's basically a way that I could show it. I know I'm going to show this. I'm going to share my screen right now. So I apologize if you're listening on the podcast. So you might want to pop over to YouTube to look at this.
Yeah,
but
we'll
Ben,
always include it in our show notes like we always do.
Yeah, definitely. So Ben, can you see this right now?
Yep.
All right, so I know this is something that Ben and I made up a couple of years ago, and basically it's showing like the hidden, the expense ratio and the hidden fees associated with that. So I know this is a kind of a big assumption, but let's just say you had $100,000 currently in, your account, and let's just say, you're 30. We're gonna say you're gonna leave it in there for another 40 years, so that'd be 70 when you start taking withdrawals. I know it's kind of a blown up example, but let's just say you have $100,000 in there. We're assuming a 10% return. Well, something that we always like to point out is not only does your money compound, your fees that yet you're paying someone else compound, and it's considered like a lost cost or a sunk cost. So, in your first year, 100,000 across the board, that's awesome. If one expense ratio is 0.5 versus 1% versus 1.5, you can see the differences. So after 5 years, on a 10% return, if you had no expense ratio, it's at 161,000. Well, if a 0.5 return, it's 157,000. And then 1%, 153, and then 1.5, 150,000. Well, it doesn't seem that bad. There's a $10,000 difference after 5 years, but this starts really to get interesting after 40 years. So after 40 years, you'd have $4.5 million if you had zero expense ratio. I know that's kind of hard, near impossible to find. So even if you went from that to 0.5, you have $3.7 million, which a lot of money. And yeah, you technically lost out or lost cause of 16.6%. Then you go to 1%, you're down to 3.1 million. If you have a 1.5, that goes down to 2.6 million. So just that alone is a $1.9 million difference between zero expense ratio to a 1.5. So, Ben and I are always harping on the expense ratios, and you're like, oh, 1%, 2%, that doesn't seem that bad. Well, yeah, if you're only giving $100 and you give them $2 for it, that's not bad. But when you're putting your nest egg or your net worth, 2% of $1 million is what? That's $20,000 versus if you pay zero, that's $20,000 that you get to keep in your pocket. So it's just think of it in the law of large numbers is kind of what we always people talk about, that as things get bigger and bigger, it's more expensive basically.
Yeah, that it is scary actually how fast the expenses can run up. I think it's one of those silent thieves that we always talk about. Maybe that'll be our merch idea is tax and expense ratios are silent thieves. But those are things that you really can't ignore because that is a guaranteed return for the fund. They've locked in 1.5. That's pretty high. Like that is pretty high. We showed it just like for the sake of math and just like for presentation's sake, but it's not out of the realm of possibility. I mean, when you're comparing like a Vanguard S&P 500 index fund, you're talking 0.03%. And then if you're looking at another fund, that 1%, I mean, that's orders of magnitude different. So you really have to pay attention to those expense ratios because, I mean, they're just getting a guaranteed return from your money without a guaranteed performance. So you really do have to care. Like that's the fee for their performance. So they'd better be doing damn well if it's 1.5%. That's pretty high. So thinking about that, when you have just this giant pool, it's an ocean of funds to choose from, what are the differentiating factors that makes a good fund? And we're going to look at, what makes a good ETF, which is honestly applicable to mutual funds and whatever your retirement fund affords you to invest in. I think a lot of these are still very, very applicable given your options. So like Chris mentioned, the expense ratio really, really is key, especially when comparing similar funds. So Chris, do you want me to share the expense ratio calculator for people to take a look at?
Yep, definitely.
So when everyone is, looking at their own funds, it doesn't have to be a retirement account. I'm just saying that for sake of convenience. Do you see the calculator up, Chris?
Yep. It's all good. I see it.
So I'll make sure to share the link to this. I mean, I just Googled this. So if you want to look up expense ratio calculator, I think this is a really good representation of just a comparative analysis. So for this specific exercise, let's say you have the option to invest in the S&P 500 index fund from Vanguard. And in investment two, Chris and I have talked about Kathy Wood's ARK Invest fund, which I think was a 0.75%,
yep,
right, Chris?
I checked it. Yep.
Which is, not as high as the 1.5, but nevertheless, like it's multiples higher. So it's just something to take a look at. So when you're looking at your funds, this is the first thing you should look at is how expensive are my funds before you even kind of waste time taking a look at anything else. So let's say we started with our initial investment of $10,000 and you are socking away $5,000 per year. We'll just take like a relatively market average over the long haul, 9% over, 30 years. You take a look at the comparison of these funds. Investment one, that S&P 500 index fund, which may seem boring to people when you're doing sort of like historical performance comparisons. I think when you look at some of these active management funds, they look sexy because they might have a few percentage points higher over the 10-year. But is it $100,000 more of performance that will beat this? So I think this is sort of a two-stage comparison to take a look at is how much will this cost, assuming all things equal? You start there, and then the next thing you can do is if you want to build in some assumptions of that, the investment two will outperform, run this calculation again at like a 13% level and say, run it in the opposite sense. Like is the compound interest in the overall return of fund one versus fund two, and then subtract off the cost and see what will this fund need to perform to at least break even. That's what you're thinking about is like this fund has to consistently outperform its benchmark. Otherwise, you're just going to be eaten away by the expense ratios. And that's something Warren Buffett put his money on and won, right?
Yep.
In that bet, he challenged a few mutual funds or hedge funds to beat the market over 10 years, and they didn't win.
In the first 3 to 4 years, they were crushing Warren Buffett picking the index, and they're like, "Oh, this is easy. Like, how can we lose this?" And then, there's a gigantic correction. They were in a lot of things that were high risk, high reward, and they got punished for that. So the S&P fell, but they fell like minus 80%, minus 75%. Yeah, the S&P 500 was down like minus 29% that year or whatever. But when you're at that much of a loss, I know. Tony Robbins mentioned this in his book, Money Master the Game. He talked about, if you see a 10% loss, I forget, I'm going to mess up all the numbers, but basically it was showing, for every loss, you need to do that much more to get back to where you were. So, I think a 50% drawdown, you need 100% return in order to double. Yeah.
I think it doubles,
down
right?
Is that you need to go 100% to go up to it. So, that's really hard to do. If everyone could do that, we'd all be wealthy. So, it gets exponentially harder the lower you go down, basically.
Yeah, that's right. Because I don't know if it's like necessarily a double. It's like if you go down, I think it's like 33% down, you have to go up 50%, I think is
Yeah,
is
yep,
the figure.
exactly.
So
And there's a
it does exponentiate and spread the bigger the number is, which
mhm.
is scary. But the thing about the Warren Buffett bet, and like I will need to listen and read about it a little bit more. Something in like the 5 to 10 year range, like there's a lot of timing into that. That's not necessarily like um uh, a validation or law that it is truth. You know what I mean? There's a lot of timing built into that, and just like the track record of those managers. So, but when you just crunch the numbers, I feel like you can start to see that there's a major difference and a major benefit to just investing in low cost funds for sure.
Mhm.
Um, so let's walk through some of the key things that Chris and I like to look at when we're trying to pick funds, because when you have options to choose from, you could pick them all. But if you're doing something, on your own, I think it's always good to have sort of like some rigor built around your strategy. That's with any investment. You really should have just sort of a structure around why you're choosing certain things. So I'm going to walk through 4 more key variables to take a look at in addition to the expense ratio. So the next thing after you sort of like looked at the expense ratios when you're comparing a couple funds, maybe start with this actually, is take a look at the fund strategy. You want to take a look at like, how is this fund investing? You've probably heard of like large cap, mid cap, small cap, large cap growth, large cap value, or something of the sense there. When you are investing in funds, you don't necessarily have to pick one. I think that we've conveyed that enough already. But if you are trying to build a diversified portfolio, you can diversify with funds in a diversified. You can diversify with diversified funds, where you can take a large cap, mid cap, small cap fund, and then international funds. If you don't have real estate exposure, you can do a REIT. If your retirement program offers that for your work. So taking a look at that and deciding the best funds for those specific sectors. And it's up to you to decide how you weight it. Chris and I will walk through how we structure our own portfolios, but that's something to take a look at for sure, that you're not just kind of picking 5 different large cap growth funds because you're all in. You might as well just pick the best one. Otherwise you're not really getting a diversification benefit to like mitigate your volatility. So that's definitely something to take a look at. And then again, you're looking at all these variables throughout the process. So
Yep.
the next thing to look at, it would be the breadth or the depth of holdings. Taking a look at, is the fund diversified? You can look at the number of holdings that they have. You can look at turnover. So, well, I guess not necessarily turnover. I would look at the weighting of their holdings and the number of holdings. So what you can do, honestly, is you just type in the name of your ETF and just the ticker and look it up, and then look up top 10 holdings. You might see Google is 35% of that portfolio or of that fund. That might not be advantageous if you're looking to have sort of like a passive strategy. That's a pretty high conviction and very high load of that specific holding. So you want to see sort of low single digits if you're seeing like a fund that holds maybe 100, 150 equities. That's definitely something to take a look at, is if you're looking for sort of a broad-based passive strategy that just tracks their index. If it's an S&P 500 index fund, it should have probably close to 500 companies, sort of thinking intuitively. So make sure that the number of holdings aligns with the strategy. So the strategy is not just the title. The strategy is also like the objective of the fund. And you might hear language of something like the aim of this fund is to align and match with the long-term returns of the S&P 500 index.
Yeah. And
Great.
also another thing that you can look in the strategy, sorry to cut you off there, Ben.
No, you didn't.
But I know a lot of times you'll see in the fine print, they'll talk about rebalancing, whether they do it quarterly or annually or semi-annually. A lot of times, even in the fine print of that, they'll say, this fund doesn't allow for a larger than a 5 or 10% holding, whatever the verbiage is, of any one equity. So basically, if Amazon grew or Google grew or Facebook grew to be 5% of it, or 6%, let's just say, they're going to have to sell off down to 5%, or maybe even a lower to assume for growth, or let's just assume they sell down to 5%. They're going to redistribute that 1% into the other holdings to rebalance. So
Yeah.
basically they're selling off to rebalance to help prevent from getting too overweighted in any one company and there's too much risk, quote unquote. So they're hedging out the risk by doing that.
Yeah. And on that note, looking at their target allocation strategy that they may not disclose all the time, I would have to take a look at how consistent they are and like what metrics need to be disclosed, because I just don't know that off the top of my head. But another thing, just like a qualitative look at these funds, is if you don't understand the fund strategy, probably don't invest in it. Like if they're talking, you know, we implement quantitative algorithmic sensing of the market. If you can't wrap your head around their investment strategy, maybe look elsewhere. It's not to say that it's not a good fund, but don't invest. Like same thing with like investing in individual companies. If you don't get the strategy, maybe they don't get it either, because
if you can't explain it to a 5-year-old, you're best off not investing in it.
Bingo. So make sure you understand the thesis. You want your investments to align with your own personal convictions, your own personal strategy. Like you don't need to be an investment manager to do this, because your company or even just if you're, you know, Googling just like the best large cap growth companies, take a look at the overall objectives. It should make sense to you, because the goal of these funds, they need to last. So they sort of need to be a timeless strategy that can be flexible in tumultuous markets and in like evolving technologies. The more specific it gets, the less relevant it becomes over a long period of time. That's I guess my from the hip opinion. So make sure you understand your investments. The next variable to look at is tracking error. Now, this is especially important for index funds. I think it still matters for even more actively managed ETFs. Tracking error, essentially what that is, it's measuring the variance of the fund's performance to its disclosed benchmark. So you might want to look for something in Morningstar or Yahoo Finance, or honestly just really any ETF supported financial news thing. Look for annualized performance difference. Look at performance variance, benchmark variance, something along those lines, where you see the chart of your stock overlaid with a specific index. You know, if it's a small cap, it might be, I guess, like the Russell 1000.
Yep.
Large cap or blue chip, you might see the Dow Jones. Just you want to see that those lines really almost overlap, because if their goal is to index an index, you want it to almost, their goal is to simulate the performance of that fund. So what that'll show, if it is misaligned and there's a large tracking error, what that means is, one, I guess it works in both ways. They could be outperforming their index, but that's a risk for you, that if what you are investing in as advertised is that it's supposed to match the index, they're not investing with the thesis that they have, you know, set out to achieve. So that tracking error, you want that to be as small as possible. 0 is probably unattainable, but it is sought after. So look for that.
Mm-hmm.
Anything to add on that, Chris? I just have one more variable.
No, go ahead. Go right into your last point. I left everything you said.
Awesome. So I think, Chris, you were talking about this, is like the turnover rate of like how funds basically sell, how long they're holding things.
Yep, exactly.
Tax efficiency. That's a really big one. And I don't think I look at it enough, to be quite honest. What you can do is, again, just like this, where you're looking up the history of like the fund's historical performance. You're looking at, you know, they'll tell you the management team. You can look at the top 10 holdings. Look for distribution history on the profile of the short-term versus long-term capital gains. It might also say ordinary income or return of capital. You really don't want to see a lot of those numbers populated, because what that means is they are in the fund, they're triggering taxable events. And that is another friction into the overall cost of the fund. Mm-hmm. And with ETFs and mutual funds themselves, you're not getting charged like a bill at the end of the year of like what the expense ratio is. It is baked into the share price. So although it's not always trading at NAV, an ETF, like that expense ratio is built into the share price, where it'll sort of eat away at the net appreciation of that stock or the ETF. So that is really something to look at, is how efficient are these managers at managing the timing of their sales, the cost of proceeds. That's important to know, because the goal of like an ETF and owning an ETF is it's pretty tax advantageous just because it's a pretty liquid market and it trades like a stock. So you're not personally getting hit with capital gains at the end of the year, but it will eat away at the net appreciation. So looking at turnover rate also, that tends to lead to another hidden sort of like higher expenses in the fund. What that means is it'll be a basis of percentage. If you see a high number, like you're seeing like high double digits, like a 40, 50%, what that means is that fund is buying and selling all the time, and they probably have a short holding period. And what that means to you as the investor means that you are being exposed to potentially short-term capital gains, but distinctly capital gains in that fund. So just making sure that your fund is tax efficient, that's key, because you want to just basically own these companies, own these funds for long-term and just not have to worry about it.
Yeah.
So that's my little overview of funds. I think the last ratio that I want to talk about is just price to earnings. A lot of times the ETFs, you can get a PE for that fund. So, looking for a low cost PE, looking for a low PE and a low expense ratio, that's the key if you're trying to look for a good timing to buy. But we advocate for DCA anyway.
Yep. Dollar cost averaging for those that forgot the terminology.
Yes,
of DCA.
sir.
So I know we've done a lot of good stuff so far. So Ben, I know we've talked ad nauseum about ARK's ETF by Cathie Wood. We love Cathie Wood's insights, and even though we like a lot of her underlying holdings, I personally don't hold ARK. I don't think you do either.
No.
But I guess what are some other funds to invest in? I know we've mentioned GBCT and also ARK. What are some other ones if you want to just throw some out there for me?
Yeah, I will list the funds that I invest in personally in my Roth IRA, but I don't want to necessarily just like list out all of that right now. I think what would be beneficial potentially is to share my template and strategy of how I allocate in my portfolio. The reason being is like, I am not going to say that I have found the funds to invest in. I think it's good to understand like maybe my mentality about why I'm picking certain funds. I will list it on the website. I'm not going to list all the tickers. It's just like, I feel like noise right now just because I have so many. The way that I allocate in my portfolio, this is the same for my Roth IRA, my 401k, sort of my like long-term retirement accounts. I really stick to a pretty strict diversification strategy. And I'll just kind of list out how I do this. So I have an S&P 500 index fund, and I allocate 35% to that. And I'll usually rebalance a year and a day. So no matter what, I make sure that I'm not hitting a capital gains event if I can. So I just take a look at the tax lots of when I bought a specific allocation of the funds. I just try to minimize how much I get hit with taxes. It doesn't really matter because it's hard to, optimize that fully, but that's the way I think about it. Is every year I try to rebalance back to that 35%. Next is I have these 3 categories, and they are all like US companies. I split it evenly between large, mid, and small cap for a 10% of a total of 30%. And between those 3 funds, I split each one, the large, mid, and small, between value and growth strategies. So really, I'm actually allocating into 6 funds, 5% each. I have one actively managed mutual fund, and that's a growth strategy. I really just found a fund that I really like. It's the T. Rowe Price Blue Chip Growth Fund, which has just like really consistently outperformed. I like the underlying thesis of the company. Of the fund, I think it's like a 0.65 expense ratio. It's not cheap, but I like it. I have it in my retirement, in my 401k, so I bought it in my Roth IRA. In international markets, I'm a firm believer in having exposure to international markets. And honestly, I may increase my target allocation here just because all empires fall. Not to say like the US is about to collapse, but like I think it's very good to recognize that we are in a global economy, more so than ever. I mean, we're seeing that with the Suez Canal incident right now, that just like billions of dollars are being disrupted by one ship. So you come to realize that we really are so connected, and it is fundamental. It is just absolutely critical to have exposure to these opportunities in the market, and it gives you a true diversification. So developed markets, I have 15%, and then emerging markets, I have 10%. I guess my last note on sort of my portfolio is I definitely advocate for folks to have exposure to real estate or to commodities like a gold or a Bitcoin, whatever you can get into your retirement funds. I obviously invest in Bitcoin. I think we've said that enough for today, but I invest in Bitcoin. So that's sort of my like inflation hedge in a commodity sense. And I have Fundrise for real estate. So I don't really need to build in more real estate into my portfolio, but I definitely recommend it if you're looking to get sort of like that all-weather Ray Dalio portfolio of just like a fully diversified strategy. So that is my spiel.
So I guess unsurprising, we didn't actually talk about our percentages of allocation before the episode. We wanted to do them separately, just that way, kind of a surprise, and we just kind of see. I mean, Ben and I talk about a lot of our investments anyway, so I kind of had an idea, but our percentages are actually quite similar, so it's kind of funny. So I'll include in the show notes instead of getting bogged down with the details of the ticker symbols.
Yeah,
basically, I'm just all Vanguard though. So I have 15% in small cap index, 10% in real estate. Investment trust, real estate, ETF, Vanguard as well. I also have Fundrise, but I just kind of put a lump sum in there years ago, and I just kind of let it go with reinvesting dividends. I have a developed markets at 10%. I have emerging markets at 5%. And similar to what Ben said, I actually think that's too low. So right now I have 15% in international markets. I think that should be much higher, probably closer to 25 or 30%.
That's what I was thinking too, is actually 30.
What I want to change it to for sure. And then I have 30% in a total stock market fund. So that's basically all companies, small, mid, large, everything, growth, whatever. And then I have 30% in also 500 index funds. So that's only a top 500 S&P 500. The other one's the whole market. So I'm buying everything. Like I said, I think my risks is kind of similar to what Ben mentioned. I'm kind of overexposed, in my opinion, to the U.S. I think the U.S. is very expensive. If you look at the Warren Buffett ratio, it's very expensive. If you look at the Sharpe ratio, yes, we're not as bad as 2000 or with the internet.
Yeah.
2000 with the internet bubble. I think it was 46. Right now we're
Schiller.
at for the Schiller. My bad, not the Sharpe ratio. The Schiller was like 46. I think right now we're 35,
36, yeah.
35, 36. So we're not at, crash levels of then. I guess that's relative to the market and the GDP of the economy and everything. But we're still up there. We're higher than when the Great Depression was 29. So that just gives you, fear and greed. Warren Buffett always says, when other people are greedy is when you should be fearful, and you should be greedy when other people are fearful. Yes. So I think that's a good idea. There's also some other ones that we'll list. I know Ben and I are really big advocates of any of the Vanguard ones. Do your own research, obviously, but I love just their low expense ratios. They're the best in the business for that reason. Yeah, you're going to get hedge fund managers or mutual fund managers or ETF managers saying, we outperform all these. And that may be true in the shorter time frames of a year, 5 years, 10 years. But a lot of times, more often than not, either their funds disappear because they don't perform well longer than that time frame, or even, if they do perform well for that long, a lot of times they don't even accept new investor money because, they close off, they have the money that they have, and it is what it is. Other ones are QQQ, which is basically tracking the NASDAQ. There is SPY, which is tracking the S&P 500. That's a little bit higher than Vanguard, so I don't invest in SPY. It's, I'd rather just buy VOO. It is the same thing for Vanguard. I know the ETF Managers Group, they're a company out of New Jersey. They have Germ, Away, Gamer, iPay, Hack. I just thought they were clever names. Kevin O'Leary has one, O-Shares. I'm not invested in that. I think, the expense ratios are just too high for what they offer. And then obviously we mentioned ARK by Kathy Wood. So just kind of throwing out names, not investment advice at all. It's just kind of saying what Ben and I do and just kind of other funds that you can look at. You can always look into Robinhood and just look at various tickers, or just even Google like ETFs to look into. And I'm sure there'll be a laundry list of them on Google. Anything else to add, Ben?
Yeah, in my recent research, just like making sure I just stay up to date with sort of my own funds, because I don't ever feel like I owe anything to any of these funds. I have found that Fidelity and Charles Schwab and iShares, I think specifically Fidelity, of that bunch, has really good analogs to Vanguard. I think they have really, really good funds. Looking at it from an index sense, I'm not saying it's like outperforming the market, but like in terms of low cost, even Charles Schwab. I have a Charles Schwab Roth IRA, so I have a lot of Charles Schwab funds. I'm talking like 0.03, 0.04. They're like almost identical, both performance and expense ratios. So like depending on what brokerage you're in, like take a look at sort of like an analog to those types of funds. And even if you're looking at, I know I'm going on a tangent, but even looking at like Betterment, if you own Betterment or Wealthfront, they list the funds that they have. They'll say like a large cap strategy, like an allocation. They'll list like, oh, if something happens to this fund, we also invest in these other three. So that's actually something I was taking a look at for my own research. Is they had, I guess, analogs or backups for their main fund, to make sure that they always had options to choose from in the same strategy. So that's something to take a look at when you're doing your own research. But really the main point of this episode is, when you're setting up that retirement account or just any ETF fund portfolio, my word of caution is like, don't lust after those historical returns. Like that is an important thing to look at and to compare, but there's so much timing built into that. It may be a new fund. Maybe the fund hasn't performed well, and that's obviously you look away from it, compared to others that have been around for the same amount of time. But don't just like lust after high returns. Like look at really good, consistent funds and use some of the ratios that Chris and I talked about today. So it's always good to peel back the onion.
Yeah, that's pretty much on my end. Anything else, Ben?
No, this was a fun episode. This is something I feel like will be pretty timeless, and we can always come back and check in. But I think these sort of things are not really tied to macro events. This is just really fundamental to looking at funds. So unless something crazy happens to the fund world or to Vanguard that disrupts the market, we'll update that. But I think it's a really good place to be, is to invest in funds. Yeah.
Pretty much same ending message as always. Thanks for listening. Smash the like button if you're listening to this on YouTube. Write a review if you're listening to any of your podcast players. Follow us TikTok, Facebook, Instagram, Twitter, you name it. We're probably on that platform. I'm trying to do more stuff on Clubhouse. I'm trying to buy Ben an iPhone or get him to buy an iPhone.
You guys can send me one if you want.
Yeah. If Apple hears this, we are invested in that company. So if you guys want to buy it, send us iPhones. We'll gladly be a sponsor, first sponsor. So that's cool. But yeah, thanks guys. Thanks for listening. Hope you had a good one. We'll see you next week.
See you next week.
Bye guys.